If you're new to real estate and looking for an investment property, you might be tempted to select the property based on emotion. That's a common trap, and it's one that you really don't want to fall into. Remember, you're not going to be living in this property yourself, so your personal tastes don't really matter. Investment properties can be exciting and very rewarding if you make the right choice. But income and other rewards aside, investing in real estate can be daunting as a first-time investor. Hey everybody, welcome back to Property Ladder. My name is Krishnaz and I'm a realtor in Toronto. In today's video, we'll be diving into the 5 major considerations or key factors that you need to keep in mind when buying an investment property. Let's dive right in. Number 1, location. The reason you hear everyone going on about location is because it really is that important. An appealing location is key to getting a great return on your investment. It determines the amount of rent you bring in, the quality of your tenant, and the vacancy rate you're likely to experience. Focus on neighborhoods where demand for rental properties is strong and expected to remain so in the immediate future. A neighborhood with access to day-to-day amenities and necessities is your best bet when you're looking to hold and rent. Good schools, public transportation, parks, restaurants, hospitals, and entertainment venues are just a few of the things that will make your rental property appealing to prospective tenants. For instance, if you're buying by the lake or a condo with a fantastic view of the skyline, it can contribute to higher rentability while benefiting the property value when you do plan to sell. It's not unusual for buyers to pay a premium for properties that have a unique selling point. Consider the quality of local schools if you're dealing with a family-sized home. Not having good schools around can limit your scope of tenants. Additionally, the overall value of your rental property comes into play when you eventually want to sell it. If there are no good schools nearby, it can certainly affect the value of your investment by eliminating families with kids or couples looking to have kids in the future from your potential pool of buyers. The same applies to crime and safety. The safety of the neighborhood factors into the location's appeal as well. Do some research into crime trends before you invest in a property. There are great resources available online with local crime statistics. You'll want to find out whether those numbers are going up or down to give yourself an idea of the long-term picture. Number 2, average rents and vacancy rates in the area. When you buy an investment property, one of the first things you might be thinking about is collecting rent every month. Research the average rent in the neighborhood and work from there to determine if buying a rental property is financially feasible. Make sure any property you consider can provide enough rental income to cover your mortgage payments, your taxes, your insurance, and other expenses. Understanding your monthly finances is extremely important, as doing this will help project your desired margins and help you understand if your investment will be breaking even, cash flow positive, or cash flow negative. Keeping in mind the real estate landscape in Ontario and given the mortgage rate hikes we witnessed in 2023, budget accordingly to keep sufficient room for increases in your mortgage payments, along with other contingencies. In addition to rent, vacancy rates are an equally important aspect to consider. Research the area well enough to gauge where it might be headed in the next 5 years. If a neighborhood has an unusually high number of listings for rent which have been sitting on the market a while, this indicates a high vacancy rate, which is not a good sign. High vacancy rates force landlords to lower rents to attract tenants. Low vacancy rates, on the other hand, allow landlords to raise rents. Number 3, the job market. The job market will without a doubt have a significant impact on your investment property. A healthy and growing job market will likely spur demand for housing and ultimately result in consistent rental income. When the employment market is strong, the tenants are able and willing to pay market rent. More importantly, they're making payments on time and are meeting the demand. On the other hand, if people are struggling financially, not only does this affect the monthly rent, but can lead to higher vacancy rates, inability to find good tenants, and properties being vacant on the market for extended periods of time. This results in you as the owner having to carry the monthly cost of your investment property until it is leased. COVID was a prime example of this, as downtown Toronto was a ghost town since most tenants went back to live with their parents, leaving the units vacant, resulting in rents plummeting and many owners resorting to selling their investment properties. Number 4, future development. A city or neighborhood with a growing population and major development projects underway often represents a potential investment opportunity. New subway lines, mixed-use retail, residential development, or hospitals not only make the location more attractive to a larger pool of tenants, but also adds to the appreciation of the area and the property value. If you see an announcement about a major company moving to the area, a new hospital or educational institute being built, you can be sure that people interested in these opportunities will be in search for a place to live. Whether it's people moving within the city or from out of city or province, Growing infrastructure will always generate an influx of people into these areas looking for rental homes once they get there. If we look within the city of Toronto, the LRT construction going from east to west, which will hopefully see the light of day sooner rather than later, is expected to positively impact property prices and increase development along this new subway line. Once it's up and running, we can safely anticipate potential tenants or buyers willing to explore areas which are not as hot or in demand but have easier access to the new LRT. I would strongly recommend making a visit to City Hall or your local municipal office and inquire about future development plans in the neighborhoods you're looking to invest. It's a fantastic opportunity to stay ahead of the curve and gain insight into the potential of specific areas and how property values will be impacted from it. Last on the list, number 5, maintenance and upkeep. Some investment properties take more time to maintain than others, like vacation rentals and Airbnbs. Properties in low quality areas that aren't in good shape also have high turnover rates and will require more work on your part. The most low maintenance properties are the ones that attract stable, long-term tenants. These probably won't be the flashiest investments on the market, and that's okay. You're going for strong, steady, and stable. If you're going to manage the property yourself instead of hiring a property manager, then location also comes into play when you're looking at maintenance. Make sure your property is reasonably close to your home base. Otherwise, driving out there, or worse, flying out to deal with every little thing that comes up can become a big headache very fast. That is it for today's video. I hope you found it helpful. Don't forget to hit the like button and of course subscribe to my channel to continue watching videos just like this and learn more about the real estate market. Thanks again for watching Property Ladder. See you next time.